CEO Bob Iger delivered the third quarter fiscal earnings report for the Walt Disney Company on Wednesday, August 9th, and we were there covering it live. Hopefully you were one of the 8,000 or so folks at peak traffic during that live earnings call in our audience, and I want to take a moment to thank each and every one of you for being there. As we mentioned after the call during the analysis, there was a lot of things that were said, and frankly a lot that weren't. And we kind of wondered, how is the market and the investment world going to react to this? Well, the following morning, we got exactly what we thought would be the case. This is a great headline from Benzinga that I think sums it up perfectly. Disney's latest quarterly report was magic-free. And that's really not something the Walt Disney Company wanted to have happen. You see, even though the numbers weren't all that fantastic for the third fiscal quarter, what we were hoping that Disney would do is to give some sense of excitement to analysts and investors out there about how much better things were going to get in very short order. But Bob Iger didn't seem to deliver much on that front, and the reaction so far has been meh. But one of the big things that did get addressed was a long-running rumor about the Walt Disney Company and Apple. Would there ever be a sale/merger? Well, Bob Iger got the question, and he gave his answer. Let's talk about that. Here we go. Renegade Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's great to see everybody out there once again, and if you are like one of the many folks watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Now, articles like this, especially in the past few months, have abounded. It's been amazing to see all the people speculating once again on a long-standing rumor that eventually Apple would gobble up the Walt Disney Company. And that question actually got thrown to Bob Iger in the last moment of the question and answer session during the earnings call. We'll get to that in just a minute, but let's take a look at the Wall Street Journal article that covered the call in depth. From the Wall Street Journal, Disney gets Iger's second show on the road. Disney's fiscal third quarter report late Wednesday was an eventful one. The entertainment giant reported weaker than expected revenue and better than expected operating profit. That was due to an odd pairing reflective of a turbulent box office, slipping tourism in Florida, and less cash going out the door because of Hollywood's ongoing strikes. Certainly, we've talked about the theme parks having soft attendance, especially the Orlando parks, but that was bolstered by, frankly, the reopening of parks or the more robust attendance of parks in foreign markets, namely in Shanghai. And as I've said many times in the past few weeks and months, it's interesting to see these Wall Street publications now frequently talking about the box office problems of Disney, probably because we might have had a video a few months ago that went everywhere.
That's according to a number crunch by prominent YouTuber Valiant Renegade.
And of course, the strikes right now have put a lot of production on the back burner, at least the production that's done here in the U.S., although the Walt Disney Company, along with Paramount, Warner Brothers, and even Comcast Universal, all seem to guide towards the fact that, no worries, we've got a lot of content stacked up, and for the stuff that we don't, we're going to be buying a lot of content from foreign markets where we don't have to deal with any kind of strikes. One of the big pieces of news to come out was the fact that Disney announced the ad-free version of Disney Plus would be moving from $10.99 to $13.99 a month. There were also similar price increases percentage-wise for other streaming services like Hulu and ESPN+. Disney has got to get these things to profitability. They promised investors years ago that Disney Plus, or DTC, direct-to-consumer in general, would reach profitability by the end of fiscal year 2024. That's only about 13 months away. Now, one of the problems, of course, with streaming right now is that they are losing gobs of subscribers, particularly in India. Now, while the numbers look terrible, a loss of 12 million in this quarter alone, I could easily make the argument, and have many times, that shedding those subs in India really is no sweat off Disney's back, particularly with DTC. Those are the lowest yielding customers by far and away that Disney has on the service. They basically bring in an average of about 70 to 80 cents per month in revenue per user. Compare that to the North American market, where they're bringing in roughly 10 times that much. Now, Disney is also set to do a password crackdown a la Netflix in the past few months, which frankly worked out great for Netflix. They added about 6 or 7 million new subscribers in the quarter where that password crackdown launched. And of course, Disney is hoping for the same thing, and just like Netflix, trying to drive those new subscribers that have become unlinked from password sharing to go into the cheaper advertising-based tier, because the revenue per user on that ad-based tier is actually just as much, if not more, than the premium tier. One thing that stuck out like a sore thumb that people should be concerned about is the fact that 2 quarters in a row now that Disney has reported losses in the North American market for Disney Plus subscribers, losing roughly 300,000 in fiscal 2 and another 300,000 in this latest report for fiscal 3 that ran through June 30th. As a reminder, fiscal 2 shouldn't have been a problem for Disney Plus in North America. In fact, you think they should have added subscribers. That's when The Mandalorian Season 3 debuted, Disney Plus's most popular show, but instead of actually picking up subs, they lost. And you can see here on this chart that Wall Street Journal offers the difference between Netflix and Disney in the past 12 months, where Netflix has gained significantly, almost 87% in value on its stock price, whereas Disney has lost. From the article, Iger on Wednesday repeated an earlier commitment to improving the quality of the company's movies while also reducing the number and production cost of its releases. But he also put the studio operation on the top of his list of 3 businesses, quote, that will drive the greatest growth and value creation over the next 5 years. Again, this is something very new to hear coming out of Disney, saying that they need to improve the quality of their product. That means they're acknowledging the fact that the quality of their product in the last few years has been rather bad, at least especially considering the enormous budgets they spend on these movies. We've covered that here ad nauseum. $200 million average seems like the norm these days for Disney, at least with a stated budget. And oftentimes what these live-action pictures from places like Marvel come in at is much higher, usually these days reaching or even breaching $300 million in total expenditure. Throw Indiana Jones and the Dial of Destiny in there as well. They've simply got way too many movies, namely almost every single one of them, that need to hit $800 million to $1 billion at the theatrical box office just to break even. Because as a reminder, these movies really don't have any revenue generation after they leave the theaters. They go to Disney Plus. Disney doesn't license these things out to other carriers like Amazon Prime and Netflix anymore. They took those billions of dollars right off the table. And frankly, physical media and PVOD sales, that's premium video on demand, aren't going to make up for these big budgets. The company's linear TV business was notably absent from this list, and Iger on Wednesday didn't backtrack on comments made during a CNBC interview last month, in which he seemed to raise the possibility of selling off some TV assets such as ABC and FX. Disney also struck a notable $2 billion deal Tuesday with Penn to allow the ESPN brand to be used in Penn's online sports betting service. But investors seeing dollar signs from divestitures should catch their breath. Iger noted Wednesday that any strategic moves with its TV networks would need to preserve its ability to produce content for its streaming operations. That will make any such deals much more complex, to say the least. Now, let me address some of those rumors as well. We've heard a lot talked about in different spheres online and social media, on YouTube, in fact, that Disney might look to sell certain studios, be they Pixar or Lucasfilm. And I have been an absolute no on that since day one. There's no way that Disney is divesting themselves of some of their headline content that is so inexorably linked throughout the company, especially in the theme parks themselves. Think of places like Galaxy's Edge, or all the Pixar characters, or all the characters that they have in all of their parks. They would basically have to turn around and license them out from a company that they sold it to. That's not going to happen. And Bob Iger has made it very, very clear what he considers core Disney. And those include the studios, as he reiterated during that call, like Marvel, Lucasfilm, Pixar, Walt Disney Animation, go on down the list. Core content for Disney is also things like live sports. So while Bob Iger might be looking to get rid of the delivery system for some of these things like ABC, the core content that is on it right now will stay at Disney. And that's why it's going to make the sale of something like ABC, FX, even Nat Geo that much more difficult. Who wants to buy a declining asset like an over-the-air broadcast station or a linear broadcast cable channel when cord cutting is rampant right now? After all, that's why Disney wants to sell these things in the first place. Somebody would have to come in and offer so low an amount as to make it amenable for them to try to do something with it that it doesn't even seem worthwhile for Disney to take the offer. But then again, stranger things have happened. We'll just have to wait and see. And finally, one of the analysts on the call during the Q&A asked Bob Iger to address the 800-pound gorilla in the room, and that was, a Disney sale to Apple? Well, don't count it out this time. That from the Hollywood Reporter just a couple of days before the earnings call. And guess what? Bob Iger gave the same answer that I've been telling people for months since this rumor resurfaced and started circulating everywhere again. The regulatory environment for a deal like that would be very hostile, and Disney and Apple would spend years trying to get that through places like the Federal Trade Commission, the FTC, or how about the FCC, the Federal Communications Commission, because of ABC and its over-the-air broadcast affiliates. And that doesn't even include foreign regulatory bodies that they would have to face in the EU. You're talking about two components of the Dow Jones 30 Index. You're talking about two of the biggest companies in the world, at least ones that aren't owned by a government. You're talking about the single largest private company in the world, Apple, and you're talking about the largest tech company in the world, Apple, and then combining it with what is regarded as the largest entertainment company in the world, Disney. Theme parks, movie studios, television, music, and film distribution. It would be a nightmare. And any such deal, even if Apple were to offer something amenable to the board and to the shareholders of the Walt Disney Company, who both would vote to approve something as wild as that, if the terms were correct, Disney would probably still get shut down when they walked into federal regulators' offices and spend perhaps hundreds of millions of dollars, if not more, fighting it out in courts over the next 3 to 4 years. And even if something like that were to get through regulators over the course of time, well, Disney would probably have to be stripped and sold off for parts before Apple could take, say, the film studios from it or the theme parks. There would be a lot going on there, and it would be a hot mess. And of course, I don't think Bob Iger wants the end of his legacy to be the man who dismantled the Walt Disney Company. So let me know your thoughts in the comments below going forward. What do you think is going to happen with Disney from here? They've been the biggest story by far out of Hollywood in the entertainment world for the last couple of years because of all their blunders and trips and falls and basically self-inflicted wounds. People ask why we cover Disney so much. Well, they keep making all the news that people want to hear. Make sure you hit that like and subscribe button. Catch us on the Sunday live show. We'll have some great guests coming in this weekend. And until then, take care.